The price on your screen right now, 86.96 spot in New York, is not the price the world is actually paying for silver today. Curious. In Shanghai, at the physical exchange where metal changes hands against real delivery obligations, that same ounce of silver is trading at $98.82. That is a $11.86 gap. Not a rounding error, not a data anomaly. Surprised. A structural chasm between two systems that are supposed to be pricing the same metal, and that gap just widened again overnight. Here's the piece of mathematics that should stop you. The CME Group's own vault data, published as of March 9, 2026, shows 78.5 million ounces of registered silver, the only metal actually available for delivery against futures contracts. Against that sits 7.4 times more paper silver in outstanding contract claims, 7.4 to 1. That ratio has been tightening for months, and something happened in the last 72 hours in the market structure that makes those two numbers, 78.5 million ounces of real metal versus the paper claims piled on top of it, face each other in a way they have not faced each other before. By the time this video is done, you are going to understand exactly why the screen price and the physical price are telling two different stories, why the gap between them is not random noise, but a measurement of system stress, and what three specific verifiable events you need to watch over the next 48 to 72 hours that will tell you which direction this resolves. To understand what is actually driving this 1186 premium, you need to hold three separate developments in your head simultaneously, because each one is significant on its own. When you see them operating together, the picture becomes very clear. Start with the physical supply side. The Shanghai Gold Exchange, China's primary spot market for precious metals operated under the supervision of the People's Bank of China, and the only venue in China where physical delivery is mandatory, does not trade paper promises. When a participant buys a contract on the SGE's AG T+D instrument, the most liquid silver contract in the world's largest silver-consuming economy, that participant receives actual metal. That is the structural difference that makes the SGE's price signal meaningful. When the SGE trades at a premium to COMEX, it is telling you that physical buyers in the world's largest industrial silver market are paying more for real metal than the New York paper price says that metal is worth. Today, that premium is $11.86 per ounce. In December 2024, comparable analysis showed premiums around $8. The number has grown. The direction is not ambiguous. Now layer in what happened to the supply side of that equation. On January 1, 2026, China's Ministry of Commerce formally elevated silver to the same regulatory category as gallium, germanium, and rare earth elements, materials the Chinese government classifies as strategic. That classification change came with an immediate practical consequence. Silver exporters in China now require state-issued licenses to ship metal overseas. China currently controls between 60% and 70% of global refined silver supply. The CNBC report published December 31, 2025, cited an unnamed industry insider confirming that the new policy formally places silver's export controls on the same regulatory footing as rare earths. The EU Chamber of Commerce in China found in a flash survey of its members that a majority expected to be affected. Only 44 companies have been approved by Beijing for silver exports under the new 2026-2027 framework. 44, globally, for a metal that feeds the solar industry, the electronic supply chain, the EV battery ecosystem, and the defense manufacturing base. This is not a quota reduction. This is a gating mechanism, and the gate is narrow. Now set that against what has been happening inside COMEX over the same period. According to analysis published by a documented Substack tracker monitoring CME Group delivery reports, March 2026 opened with 10,526 contracts standing for delivery, representing 52.63 million ounces, against a registered inventory base of 86.13 million ounces. February 2026 had just delivered 5,036 contracts, or 25.18 million ounces, making it the highest February delivery volume in modern COMEX history. The pattern that precedes delivery stress is delivery concentration, buyers standing for physical metal rather than rolling their positions to the next month. In February 2026, 37.3% of all deliveries for the entire month settled on the very first notice day. That is not normal behavior. That is institutional participants signaling urgency. The CME's own data shows the current depletion estimate at approximately 62 trading days at the recent 30-day withdrawal pace. At the current rate of withdrawal from registered stocks, the deliverable pool reaches a level that makes orderly delivery mathematically impractical in roughly 12 weeks. That is not an ideological claim. That is arithmetic applied to the CME's own reported figures. Here's the piece of this story that most mainstream financial channels have not connected to the Shanghai premium. China's factory gate prices for silver refining surged 16.9% year over year in February 2026, according to China's National Bureau of Statistics producer price breakdown released this week. That number is not a spot price move. It is the cost to physically process and refine metal inside the world's largest silver processing nation. When refining costs inside China jump 16.9% in a single year, it means the fabricators who make the solar cells, the semiconductor components, the EV connections, are absorbing serious margin compression on every unit they produce. They are not reducing their silver purchases. Silver's conductivity has no substitute in photovoltaics at commercial scale. They are paying more, sourcing harder, and building inventory wherever they can find it. That industrial floor underneath the Shanghai price is what makes the $98.82 figure durable, not speculative. Now, we need to talk about what changed this week specifically, because the Shanghai premium has been elevated for months. Something accelerated it. On February 28, 2026, the United States and Israel launched Operation Epic Fury against Iran. That operation closed the Strait of Hormuz, the passage through which approximately 20% of the world's oil supply transits. Within days, Brent crude moved from around $70 a barrel to above $110. Iraq, Kuwait, and the United Arab Emirates cut production. The International Energy Agency called an emergency meeting and approved its largest ever coordinated release of oil reserves, 400 million barrels, to stabilize markets. As of today, March 12th, the DXY dollar index has recovered to 99.37, rising for the third consecutive session as oil resumed its climb and reduced expectations for Federal Reserve rate cuts. The Fed meets on March 17th and 18th. Officials are in their pre-meeting blackout period. The market is currently pricing in rates unchanged, with the first potential cut pushed to September at the earliest. Here is the structural connection to silver, a DXY at 99.37. Rising because oil inflation is suppressing rate cut expectations creates short-term mechanical pressure on precious metals denominated in dollars. When the dollar index strengthens, algorithmic models sell paper silver positions. That is what has pushed the New York COMEX spot price down to $86.96 today, giving back some of the gains from the March 10 session, where silver closed above $90. But the dollar strength creating that COMEX pressure is itself a response to oil inflation that is, in part, a direct consequence of a war that closes the Strait of Hormuz. Meanwhile, in Shanghai, where pricing is driven by domestic industrial demand rather than dollar correlation, the price remains at $98.82. The gap between the two systems has widened precisely because the macro event causing New York to sell paper silver is entirely irrelevant to why Chinese manufacturers need physical silver to make solar panels. You can print contracts, you cannot print the metal itself. This brings us to the historical parallel that gives this moment context. In March 1980, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had accumulated a position in silver futures and physical metal so large that it represented a substantial fraction of the world's known silver supply. When silver reached $50 per ounce and the COMEX exchange changed its margin rules to prevent further buying, the price collapsed. The exchange intervention broke the corner by changing the rules at the point of maximum stress. What happened before the break, the surge, the premiums, the delivery demand that outran available supply, was structurally similar to what we are observing now in one respect. Delivery demand accelerating faster than registered inventory. But here is the key difference between 1980 and today. The Hunt brothers squeeze was a single-actor, speculative position that the exchange could dissolve by margining the Hunts out. What is happening in 2026 is not a speculative corner. It is industrial demand. Chinese solar factories need silver to make panels. EV manufacturers need silver for battery contacts. Semiconductor fabs need silver for circuit traces. None of those buyers can be margined out. You cannot change the rules on a manufacturer who needs physical metal to run their production line tomorrow morning. The demand is structural. The supply constraint from China's export licensing regime is a government policy decision, not a speculative position. There is no margin call that unwinds it. This is why comparing the current situation to the Hunt squeeze actually reveals why today is potentially more durable. The mechanism producing the delivery stress is not leverage, it is consumption. Which brings us to the part of the picture that deserves honest scrutiny. The strongest counter-argument to everything presented above is this. COMEX has delivered through perceived crises before. The exchange has mechanisms, conversion of eligible silver to registered, exchange for physical arrangements, cash settlement provisions, and the exchange's own authority to modify contract terms during stress that have historically prevented the mathematical impossibility from becoming an actual default. The February 2026 analysis published by market tracker jinlo.substack.com, which provided the March delivery figures cited here, also notes explicitly that COMEX maintains extensive authority to modify contract terms during market stress, and that the same silver can satisfy multiple delivery obligations through warrant transfers. The counter-argument is not negligible. COMEX has managed 7-to-1 paper-to-metal ratios before without a disorderly event. Skeptics are right to note that the math gap alone has never been sufficient to predict a specific outcome. What today's data changes is the simultaneous presence of three factors that were not all present in previous stress episodes. The Chinese export licensing regime, a sovereign government policy that cannot be arbitraged away, has removed the supply buffer that historically allowed Western paper markets to source physical metal from Shanghai when needed. The Iran war has introduced an oil price shock that is suppressing paper-silver prices through DXY strength at the exact moment physical demand in Asia remains structurally elevated, and COMEX registered inventory at approximately 78.5 million ounces, with a 62 trading day depletion estimate, is operating at stress territory levels according to the coverage ratio data that the CME's own system tracks daily. Uncertainty, however, remains real. The Iran conflict could de-escalate faster than markets currently price. Trump has signaled several times that he considers the operation largely complete. A rapid ceasefire agreement would ease oil prices, weaken the DXY, and provide mechanical support to the COMEX paper price, potentially narrowing the Shanghai premium as the two prices move toward each other from different directions. Markets can and do respond to geopolitical resolution faster than structural supply deficits resolve. That is an honest acknowledgement of what could change the short-term picture. Here are 3 specific verifiable things to watch over the next 48 to 72 hours. The first is tonight's CME Group Silver Vault report, published daily at approximately 6 p.m. Eastern Time and accessible directly at cmegroup.com under the Delivery Reports section. The specific number to watch is registered inventory. If it falls below 75 million ounces while the March contract still has active delivery notices outstanding, the coverage ratio enters what the analytical community formally classifies as stress territory. The CME's own data shows the boundary at 15% coverage. Verify the number yourself against the open interest figure for the front month contract. The second is the FOMC meeting outcome on March 18th. Federal Reserve officials remain in their pre-meeting blackout period through the weekend. The market is pricing rates unchanged. What matters for silver is not the rate decision itself. It is the language in the statement and in Jerome Powell's press conference regarding the Fed's interpretation of whether the Iran war oil shock constitutes transitory or persistent inflation. If the Fed signals that energy-driven inflation limits its capacity to cut rates through 2026, the dollar could strengthen further, maintaining mechanical pressure on the COMEX paper price while the Shanghai physical price remains disconnected. That divergence tells you that the two markets are operating on genuinely different information about the same metal. The third thing to watch is the Shanghai Gold Exchange's benchmark silver report for the trading week ending March 14th, which is published by the SGE directly at en.sge.com.cn. The specific data point is the EDGE T+D closing price converted to USD using the day's USD-CNY fixing rate. If that price remains above $95 while the COMEX paper price is trading in the mid to high $80 range, you have a premium that has remained above $10 for 2 consecutive weeks. Historically, when the SGE COMEX spread sustains above $10 for more than 14 days, it has coincided with subsequent periods of upward price pressure on the COMEX benchmark as the physical signal bleeds back into the paper market. That is not a prediction. That is a pattern documented in the spread data that you can verify yourself. What is actually being revealed by today's $11.86 gap is a process that has been building for several years, but is now visible to anyone looking. Global silver has operated for decades under a pricing system in which the paper markets in New York and London set the headline number, and the physical market in Shanghai accepted that number as its reference point, partly because Chinese supply was available to arbitrage the gap whenever it widened. The Chinese export licensing regime that took effect January 1, 2026 has changed that relationship. When China restricts the flow of refined silver out of its system and simultaneously maintains massive domestic demand for that same metal, the SGE price is no longer anchored to COMEX. It floats on its own fundamentals. And its fundamentals are 60% to 70% of global refined supply now prioritized for domestic use, 5 consecutive years of global demand exceeding supply, industrial buyers who cannot substitute away from the metal, and a physical delivery system that settles in actual bars. The 86.96 you see on your screen is a real price. It is the price of a paper claim on silver in New York, subject to DXY pressure, speculative positioning, and algorithmic trading models that respond to dollar strength and oil price volatility. The $98.82 in Shanghai is also a real price. It is the price of a physical ounce of silver in the world's largest physical delivery market, settled against actual metal by industrial buyers who need it this week. Those two numbers have not been the same for a while. The gap between them is widening. The question is not which one is right. Both are real. The question is which one has more information about where the global price of physical silver goes when the paper and physical systems are forced to reconcile. Given that March 2026 COMEX delivery demand stands at 52.63 million ounces against 78.5 million ounces of registered inventory, and given that China's export licensing has removed the historical safety valve that allowed Western paper markets to source physical metal from Asia when inventories tightened, where do you think the COMEX registered inventory number sits by April 1st, 2026? Drop your estimate in the comments. I will pin the most detailed, data-supported analysis. The March 18 FOMC meeting is 6 days away. I will have the analysis up that evening the moment the statement drops, with specific reference to how the Fed's language changes the calculus on the paper physical spread. If you want that the moment it's published, subscribe and turn on notifications. That is the event that matters next week. Everything cited in this video is sourced from publicly available data: CME Group Vault reports, SGE benchmark data, CNBC's December 31st report on China's export licensing announcement, China's National Bureau of Statistics February producer price release, USA Gold's daily market report, and archived analysis of COMEX delivery patterns. Every source is linked in the description. I am not a financial advisor. This is not investment advice. Verify every number yourself before making any decision. The links are there. Do your own research. Make your own call.